I'm going to give you an example of liquidity. I'm going to put up Brett Whistle again. So I'm putting in a $10,000 credit card. I owe $10,000 at 27%. Okay. All credit cards are amortized over 240 months. Now, let me show you this. $10,000 at 27%. How does that make you feel when you see that? I got a credit card. My Visa is $10,000 and they're charging me 27% interest. How does that make you feel when you see that? You see $10,000, they're charging you 27% interest. How does that make you feel? Good, bad, indifferent? Does it strike fear into the heart of man? You tell me. What's going on with that? Okay? So now, let me show you what's really going on with that. If all the financial gurus are telling you need to pay that off, go ahead and pay that off because that 27% is killing you. 27% a year really means 2.25% a month. 2.25% a month. So if you paid this card off today, you would only be saving 2.25% of the $10,000. That would be the interest charge. Let me show you what that becomes. $225. You pay that card off today, even at 27%, you will only save $225. So if you pay that off, remember, you have liquidity. That is, you borrowed Visa's money, and now it's time to pay Visa's money back. Let's say you have the choice of paying them back their $10,000 so you can avoid $225 in interest. Or because all of this money is liquid, this is Visa's money, I'm going to choose not to pay Visa this month. I'm going to choose to take their $10,000, Visa's $10,000, because it's liquidity, and put it on my mortgage instead, make the minimum payment to Visa, and give them their $225 they're looking for. But I'm going to take their money and put it on this mortgage. I need you to take a look at cumulative principal here. Let's scroll down. Let's scroll down. Let's scroll down. $10,000 applied to this loan knocks off 32 payments. 32 payments. That's about 2.5 years off this mortgage with that $10,000 and save $45,000 in interest. So here's the point I'm trying to make. All of this money is liquidity. All of this money is liquid. How you use other people's money can make a huge difference to you if you learn how to do the math or let somebody else do the math for you. I just showed you how you can ask yourself, do I want to pay Visa $225 to use their money and put it on my mortgage instead and save 45 grand in interest and knock off 32 payments I never have to make? You tell me. You tell me, does it make sense to make that move? In other words, what we're asking is, would you pay $225 for the ability to save $45,000 in interest you never have to pay? I'll pay you $225 in interest so I can take your money so I can save $45,000 in interest. Is that a good play? You tell me. You think about it. Ladies and gentlemen, all we're doing here is telling you what you need to know to get the basics of understanding prepayment of principal, isolating the principal amount, leverage, and liquidity. And take your extra money and apply it strategically to your loan when the program tells you to. And you can cut your interest cost on this loan by 75%. In other words, the bank is looking for $347,000. Let's just divide that by 3. If I cut it by 75%, that means the bank is looking for $347,000. They're going to get $115,000 or less. My clients will actually pay less than this. We could probably get this down to $100,000 or $90,000. Okay? Give the bank that much money to get the same $300,000 house. And by strategically saving up the money and every few months placing a few $1,000s on the debt that we get out of the savings account, after building it up, pay this loan off in about 7 years. I just showed you how we could knock off nearly 3 years with some saved up money. What if we didn't do anything until we saved up that money again and place it on the debt, and then wait to build it up again and then place it on the debt? Wait to build it up again and place it on the debt. That's not taking any money away from your family. That's not taking any money away from your lifestyle. That is, you're figuring out how much I'm going to spend on lifestyle. I'm going to figure out how much I'm spending on my bills. I'm figuring out how much I'm saving. All right. All of that is a part of my budget anyway. But any money that's left over after that, discretionary spending, put it in the bank, build it up, and let our AI system tell you how long to leave it there and when to take it out and apply it to this debt, and knock off years, knock off months, knock off interest payments you never have to make, and pay somewhere between $90,000 and $110,000 in interest instead of the $347,000 the bank wants on this money. Wanda Geiger, watching us on YouTube, says, brilliant, brilliant. And listen, folks, all I'm trying to tell you is what I've learned over the years from looking at this thing a different way. I have ASD. Some of you may understand that as autism spectrum disorder. When I look at this amortization schedule, I see all of these things and more in this amortization schedule, and I'm just sharing it with you so that you can finally start learning the stuff we should have learned a long time ago. This should be taught at least in junior high. You should be learning how the banks make their money through interest starting in junior high, high school, college, wherever it is. You should be learning this. Do you know it's not taught anywhere? Our business is an education business. Our business is financial education. We just use technology to support the education. You're not going to get this education anywhere else. Are there other programs out there? Listen to me now, okay? There are other programs out there that are cheaper than ours. You better believe it. Way cheaper. Some of them are actually free, but you will pay more in interest than you need to pay because no other program on the planet focuses on how to optimize interest savings. And it's the interest cost on these loans that is the main ingredient in keeping you in debt forever. The interest cost on the loan is the difference between paying off a $200,000 car in just 7 years and taking 30 years to pay off a $200,000 house. The way that they do the interest cost makes all of the difference. Our program not only shows you how to get out of debt, our program teaches you and your children how the whole system works, and stop looking at debt as a negative and start learning how you should look at it. It's called managing your credit. Manage your credit properly, and you can buy your house in about 7 years instead of 30. Then get another house, take the house you just bought, make it into a rental, get a nicer, bigger house, and have that rental money help you to pay off your next bigger house in even less time, a more expensive house in even less time. Let's say you could pay that one off in 5. Now you got 2 houses paid off. Are you going to stop there? Are you going to have 2 houses that are now rentals or short-term rentals and get a third nicer house? The possibilities are endless. You're gathering up all of this net worth, houses that are paid off, houses that are worth something, that in your retirement you can have money coming in from rents on paid off houses. And then when you want to get another house, then you just cash out refi on one of the houses and put down payments on like 5 or 6 more. Take a cash out refi on one of the houses and then buy 5 or 6 more, put down payments on more houses with the cash out refi. Use that equity to build up a net worth for your family that's second to none. You can become your own private family bank trust, plus saving money and interest on your loans, plus building up cash value in life insurance, plus showing you all sorts of things you can do that you never knew how to do before with your money. Stop giving your money to the bank. Pay them less money and get more net worth for less money so that you can start building using compound interest to work for you and your family. And then truly, you'll start creating generational wealth.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L. method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.